Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Marvell technology.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into the truly incredible numbers on today's stock, if you're looking for a cleaner way to read your trading charts, check out VIP Algos.
Yeah,
The link is down below in the description.
right. VIP Algos, it's a TradingView indicator suite. And I love that it actually shows you visual buy and sell chart alerts.
Oh, absolutely.
Plus, it has tools for trend direction and support and resistance zones.
Yeah, and it also gives you those take profit and stop loss planning areas, which is, that's huge, right? Whether you're looking at stocks or Forex, crypto, gold, whatever market you follow.
Definitely.
But we just want to remind you, VIP Algos is an educational chart analysis tool only. It is not financial advice.
Right, exactly.
Yes.
It does not place trades for you, and it certainly doesn't guarantee profits.
Yeah.
Trading always involves risk, so please manage your risk and, do your own independent research.
And just full disclosure here, that link in the description is an affiliate link, meaning we may earn a commission if you use it at absolutely no extra cost to you.
Okay, so let's unpack why Marvell technology is completely dominating the conversation today, because the context we're dealing with is, well, it's absolutely mind-blowing.
It really is.
If you're listening to this and, looking at your portfolio, you might already know this name. We are looking at a stock that has skyrocketed 260% in 2026 alone,
Just massive.
hitting an eye-watering high of $329.88. And let's be clear, this is not just retail hype, right?
Yeah.
Or some speculative meme stock frenzy driving this action.
Not at all. You have NVIDIA taking a massive $2 billion equity stake in the company.
$2 billion, that's not pocket change.
Exactly. And that wasn't just some quiet backroom deal. Jensen Huang, the CEO of NVIDIA, essentially gave them this massive personal endorsement live on stage at Computex. And, when the architect of the modern AI revolution stands in front of the world and validates your technology, the entire global market snaps to attention.
Yeah, they really do. But I think the real mission for our analysis today is to figure out what happens next, right?
Yeah, exactly.
Is this AI infrastructure giant still running on a wide-open highway with room to accelerate, or is a 260% gain a blaring signal that the stock is now priced to absolute perfection?
That's the billion-dollar question.
It's one thing to ride a momentum wave when nobody's watching, but it's another thing entirely to hold a position when expectations are this astronomical. All right, let's move into the wealth building context.
So when you think about multi-year, long-term portfolio growth right now, you really have to follow where the real institutional capital is flowing.
Right.
And right now, it is entirely flowing into the AI infrastructure supercycle. As we established, this isn't some speculative play. Marvell represents the essential picks and shovels of this AI gold rush.
The infrastructure.
Right. They are building the foundational plumbing, the literal physical hardware that makes the entire AI ecosystem actually function on a global scale.
I have to admit, though, I get naturally skeptical whenever I hear a buzzword like supercycle.
Sure. Yeah.
Because we've seen tech trends come and go, right? With all the hype surrounding AI right now, how does a long-term investor actually differentiate between a fleeting trend, something that might just be a standard 2-year hardware upgrade cycle, and a true permanent and structural shift in how data centers are fundamentally built?
That's a great question. The difference ultimately comes down to the unforgiving laws of physics.
Physics.
Yeah, physics and the sheer raw demand for bandwidth. We are currently undergoing this permanent physical leap to 1.6T optical interconnects.
Okay.
The old way of building data centers is it's physically breaking down under the strain of artificial intelligence.
Okay, translating that for the listener, because 1.6T optical interconnect sounds like something out of a sci-fi novel.
It does, yeah.
What does that actually mean for the physical reality of a data center?
Think of a modern data center as a massive, sprawling city of computer chips. For decades, those chips communicated with each other using copper wires.
Right, the standard cables.
Exactly. Copper was the standard dirt road of the internet. And it worked fine when data was moving at normal human speeds. But AI training models, they require so much data to be moved so incredibly fast that those copper dirt roads are causing massive traffic jams.
Oh, I see.
And even worse, pushing that much data through copper creates immense physical heat.
Oh, right, because of the electrical resistance.
Precisely. The copper literally can't handle it anymore without degrading the signal or just straight up melting nearby components.
Wow. So the industry basically has to upgrade the infrastructure from a Dirt road to a high-speed bullet train.
Yes. And that bullet train runs on light. You have to use optics, sending data via lasers over fiber optic cables.
Enter Marvell.
Right. Marvell manufactures the digital signal processors, the DSPs, that translate those electrical signals from the computer chips into light, which is what allows them to communicate at mind-bending speeds across the data center. This isn't a temporary trend where people might just, go back to copper later.
Copper is basically obsolete for this.
Copper is physically dead for these specific high-intensity AI workloads. This is a one-way structural shift in human technology, and Marvell is supplying the essential materials for it right alongside their highly specialized hyperscaler chips.
That one-way structural shift is exactly what long-term investors need to see. They aren't just selling a slightly faster version of an old technology. They're selling the only technology that mathematically works for the new reality of AI computing.
Exactly.
Now let's look at the fundamentals.
Because the financial engine driving this entire narrative is what actually has to support that massive 260% stock surge. The story is great, right? But the math has to back it up.
And the numbers they just posted are staggering.
Yeah, they are.
In their fiscal first quarter, which ended May 2, 2026, they generated a record $2.418 billion in total revenue. That's up 28% year over year.
Massive.
But the real story is under the hood when you break down where that money is coming from. Data center revenue specifically made up 3/4 of that total, coming in at $1.833 billion, which represents a massive 27% jump.
Right, but you have to remember, the market doesn't price stocks based on what a company did yesterday. It prices them on what they're going to do tomorrow. And Marvell's management has completely blown the doors off their forward guidance.
They really did.
They guided Q2 fiscal year 27 revenue to $2.7 billion. That's impressive. But the multi-year view is where the numbers get truly wild.
Yeah.
They are forecasting fiscal year 27 to hit $11.5 billion in revenue, and then stepping up massively to $16.5 billion in fiscal 28.
That's crazy.
That is a 50% year-over-year revenue increase.
Pausing on that for a second. A 50% increase at that massive scale is almost unheard of in hardware.
Yeah, it's practically unprecedented.
Going from a few million to a few billion is one thing, but adding $5 billion in new top-line revenue in a single year requires incredible execution.
Absolutely.
And usually, chasing growth like that means a company is burning a massive amount of cash to scale up.
Right, the cash burn.
So let's look at the balance sheet health, because they aren't actually burning cash at all. They are sitting on $3.844 billion in cash right now, compared to $4.961 billion in debt. And they generated $638.8 million in operating cash flow in just one quarter.
That's just a phenomenal cushion. Furthermore, their gross margins are sitting strong at 58.9%.
That's really healthy.
It is. This combination of explosive top-line growth and rock-solid financial health is what builds their true competitive moat. They've aggressively positioned themselves as the ultimate sort of one-stop shop for AI connectivity.
Yeah.
We mentioned the optical transition a moment ago. Their 1.6 terabit per second PM4 DSP, which they call ARA, is the undisputed industry standard.
Let's quickly define PM4 for anyone listening who isn't a semiconductor engineer. Good idea. PM4 stands for pulse amplitude modulation. In simple terms, instead of sending data in simple binary just ones and zeros, on or off PM4 allows the light signal to operate at 4 different amplitude levels.
Right.
It essentially crams twice as much data into the exact same pulse of light.
Which is exactly how they achieve those mind-bending speeds. And the moat here is that massive optical module vendors companies like Coherent and Lumentum.
Who actually build the physical pluggable transceivers for data center.
Right, exactly. They rely almost entirely on Marvell's PM4 silicon to make their own next-generation products function. Without Marvell's chip inside, the rest of the optical hardware is completely useless.
So they essentially own the toll booth on the new optical highway.
That's a great way to put it.
But you also mentioned their bespoke hyperscaler chips earlier. This is the custom ASIC side of the business application-specific integrated circuits.
Yes.
They are making custom silicon for the massive cloud providers, specifically Amazon Web Services Trainium chips and Microsoft's MAIA chips.
Yep, the big players.
And by co-designing these chips with Marvell, AWS and Microsoft are saving 30% to 40% compared to buying merchant GPUs from other major vendors.
I mean, just think about the scale of capital AWS and Microsoft deploy every quarter.
Tens of billions.
Right. Saving 30% on your core compute infrastructure translates to billions of dollars flowing directly to their bottom line. It's a massive financial incentive to go custom.
The way I think about it is like buying a suit.
Oh, I like this.
Buying a merchant GPU like a standard off-the-shelf chip is like walking into a high-end designer store and buying an incredibly expensive premium off-the-rack suit.
Okay.
It's fantastic, it works brilliantly, but it wasn't made specifically for your body. You're paying for extra fabric and features you might not even need.
Right, it's generalized.
Exactly. Marvell's custom ASIC business is like walking into a master tailor shop and having a bespoke suit measured and cut precisely for your exact frame. It fits AWS and Microsoft-specific AI workloads perfectly. By stripping out all the generalized computing features they don't need, the chip runs faster, uses far less power, generates less heat, and paradoxically saves them a massive amount of money.
And because Marvell has all the necessary intellectual property under one roof, they own the compute IP, the networking IP, and the optics IP. They are the master tailor that every major cloud provider is lining up to hire.
That brings us to the catalyst timeline. What specific events are going to actually move the needle for this stock in the next few months?
Well, the biggest immediate event is their Q2 fiscal year 27 earnings report coming up in late August.
Okay.
Wall Street is going to be laser focused on that $2.7 billion revenue guide we just broke down. They want to see if Marvell hits the high end of that number, but more importantly, analysts want aggressive updates on how fast those 1.6T optical chips are actually ramping up in production.
Because that's the future. But beyond just the raw earnings, we have to talk about their aggressive acquisition strategy.
Yes, definitely.
They're currently in the middle of integrating Celestial AI, XCon, and Polariton technologies. And these aren't just random corporate purchases to boost top-line revenue.
No, highly strategic.
These companies specialize in advanced silicon photonics and interconnects. Basically, rather than having the optical lasers sit outside the chip, silicon photonics integrates the lasers directly onto the silicon die itself.
Which is incredible technology.
Right. It drastically reduces power consumption and just deepens that massive optical moat we were talking about.
And zooming out from the company itself for a second, we really can't ignore the macro trend playing out across the broader market.
Oh, absolutely.
Institutional capital is rotating heavily into a new basket of stocks. I mean, everyone on the planet knows about NVIDIA's dominance, but the market is constantly looking for the next layer of the AI infrastructure build-out.
Right. Who's next?
We are seeing a huge rotation into what analysts are calling the mania trade.
Mania?
Yeah, mania. That stands for Micron, AMD, Marvell, Intel, Broadcom, and NVIDIA.
Wow, okay.
Being part of a core institutional acronym like that isn't just a fun nickname. It dictates steady, relentless capital inflows from major funds.
MAN-A. Wall Street really loves coming up with an acronym to justify buying, don't they?
They really do.
But let me push back on that timeline for a second. With the stock already up 260% this year, isn't it highly likely that the market has already priced in an upcoming Q2 earnings beat?
It's a fair point.
Like, if every analyst on the street knows they are crushing it, won't a standard solid earnings report just be met with a massive collective yawn by the market?
You know, the raw numbers for Q2 almost don't matter as much as the forward guidance update.
Ah, okay.
If they report a huge beat for Q2, but management leaves that $16.5 billion fiscal 28 guidance unchanged, the stock will likely sell off hard.
Because it didn't accelerate further.
Exactly. When you are priced for perfection, merely meeting expectations is a failure. The true catalyst isn't what happened in the past quarter. The catalyst will be whether management confidently raises the ceiling on their future projections.
Right, that makes sense.
Now let's pivot to the chart.
Translating all of this fundamental business success into the actual price structure is where we start seeing the momentum realities of this stock. The structural breakout is completely undeniable.
Completely.
As we said at the top, it's up 260% year-to-date, hitting that massive $329.88 high. But there's a specific mechanical market reason behind a lot of this support, isn't there?
There is, and it's a huge factor for long-term stability. On June 22, 2026, Marvell was officially added to the S&P 500 index.
Huge milestone.
Oh, massive. This creates a fundamental floor for the stock. The mechanism here is pretty simple. When a company gets added to the S&P 500, every single passive index fund, every target date retirement fund, and every ETF that tracks that benchmark is literally forced by their own internal mandates to buy and hold the stock.
Wow. So it essentially takes millions of available shares off the active trading market and unlocks them away in retirement accounts.
Yes.
That reduction in float creates incredible structural durability.
Add to that the extreme momentum we've seen recently. After Jensen Huang's endorsement at Computex, The stock experienced a violent 32.5% single-day gap up on absolutely heavy volume.
32.5% in one day.
Yeah, and the momentum was so strong, it followed that up with another 8% pop the very next day. A 32.5% move in a single session for a company of this immense size is just, it's staggering.
It really is.
That heavy volume gap up shows undeniable institutional accumulation. The big mutual funds and hedge funds weren't waiting for a dip. They were aggressively buying at market value at any price they could get.
But, if you're listening to this and feeling the fear of missing out, you need to understand what that actually means in practice.
Right.
Institutional accumulation is great for the long-term multi-year trend,
Yeah.
but a sudden gap up of that magnitude acts like a giant magnet for momentum traders, scalpers, and day traders.
Oh, yeah, the volatility.
Exactly. It invites massive intraday volatility. You're going to see wild stomach-churning swings as short-term traders try to slice quick profits off that momentum. Navigating that kind of violent price action is exactly why traders seek out clean chart workflows, so they can clearly visualize the overarching trend instead of just guessing on the erratic intraday swings.
Absolutely essential.
So what does market sentiment look like?
Well, we've covered the chart, but when we look at Wall Street's overarching mood, euphoric might be an understatement.
Euphoric, yeah.
The analyst actions over the last few weeks have been overwhelmingly bullish. KeyBank recently issued a note raising their price target from $260 to a staggering $385.
Wow.
Stifel raised their target to $350. Across the board, they are all citing that 1.6T optical networking side of the business as a highly durable growth engine that is going to run for the next 3 to 5 years.
And as we touched on earlier, you simply cannot get better institutional validation right now than NVIDIA taking a $2 billion equity stake.
The ultimate stamp of approval.
Yeah. That isn't just a passive financial investment. That is a deep strategic partnership.
Yeah.
It essentially embeds Marvell right into the heart of the NVLink ecosystem.
Yep.
NVIDIA is effectively saying to the market, we need Marvell's networking technology so badly to make our own systems work, we are going to buy a significant piece of their company to ensure our supply chain has access to it.
And aside from the concrete investments, there's also some heavy speculative chatter driving current sentiment right now.
Oh. Like what?
The rumor mill across tech forums and trading desks is swirling about a potential third, currently unnamed Tier 1 hyperscaler design win.
Oh, wow.
We know Marvell has AWS and Microsoft lock-in for custom chips, but if they land a third major player, say Google or Meta, that would basically lock in their stated target of hitting over $10 billion in custom revenue alone by fiscal 29.
Let me step back and play devil's advocate here for a minute.
Go for it.
When Wall Street is this universally bullish, when major analysts are casually raising their targets by over $100 in a single research note, and when the stock is surging based on rumors of unnamed contracts, isn't that usually a blaring siren that expectations are getting dangerously frothy?
Yeah, it's a valid concern.
Like, when everyone thinks a stock is invincible, isn't that exactly when you should be worried?
It is. Because when everyone is standing on one side of the boat, any slight shift in the wind can cause the entire thing to tip over.
Right.
That level of universal, unbridled optimism means the margin for error is effectively zero. Any misstep will be punished. Now let's talk about the risks.
We desperately need a reality check here to balance this undeniable hype with the mathematical realities of running a physical hardware business.
Definitely.
The most glaring, obvious risk right now is valuation. Following a 260% surge, this stock is, by definition, priced to absolute perfection. In fact, Seeking Alpha recently issued a downgrade, moving Marvell to a hold rating specifically because of this valuation. Their core argument is that all the potential upside, even the highly optimistic scenarios, is already baked into the current price, meaning that even a minor delay in their chip programs will severely punish the stock.
And those delays are a very real possibility because of customer concentration.
Okay, expand on that.
We spent a lot of time talking about that bespoke custom ASIC revenue. The problem with custom chips is that the revenue is highly lumpy. It relies entirely on the capital expenditure cycles of just 2 or 3 hyperscalers.
Oh, I see.
If AWS or Microsoft decides to pause or delay a massive data center build-out for just 1 quarter to, reevaluate their budget, Marvell's revenue takes a massive, sudden, unexpected hit.
We also have to do the math on the margin pressure.
Right.
We mentioned earlier that they are saving the hyperscalers 30% to 40% by building custom silicon. Well, those savings don't just appear out of thin air. They come at a direct cost to Marvell's own gross margins. Custom silicon generally carries lower gross margins, usually in the low to mid 50% range, compared to standard merchant silicon, which usually commands over 60%.
Significant difference.
So if the custom ASIC business becomes a larger piece of Marvell's overall revenue pie, it mathematically dilutes their overall net margins. For the massive bull case to actually play out, Marvell needs serious operating leverage. They have to sell a truly enormous volume of these lower-margin custom chips to justify the current stock price.
That is the primary bear case, and honestly, it's mathematically sound. But there is a structural mitigation here that acts as a counterweight.
Okay, what's that?
Yes, the custom silicon side is lumpy and slightly lower margin, but Marvell's optical DSP business, the chips that route the light across the data center, is highly diversified across dozens of different module vendors and carries incredible premium margins.
Oh, so it offsets it.
Exactly. That optical side of the business acts as a vital financial shock absorber. Even if a custom chip order gets delayed by AWS, the entire broader industry still has to buy Marvell's optical chips to build out their networks.
So with everything on the table, what's the final verdict?
Looking at the entire scope of the research, the macro tailwinds, the fundamentals, and the undeniable valuation risks, we are looking at a final bullish score of 8 out of 10.
Let's summarize exactly why it scores an 8. Marvell is uniquely positioned as the premier, indispensable one-stop shop for AI connectivity. They dominate the optics, they are rapidly scaling the custom compute ASIC business, and they have the direct, literal financial backing of NVIDIA.
Yeah.
Yes, we absolutely must acknowledge that the valuation is stretched thin right now. It is priced for flawless execution, and any mistake will hurt. But the recent inclusion in the S&P 500 provides a massive layer of structural mandated durability.
And that staggering guidance of $16.5 billion in revenue by fiscal 28 shows that the underlying business is actively accelerating, not slowing down.
Because of that powerful combination of factors, this is firmly positioned as a multi-year hold target for long-term investors who want foundational exposure to the AI infrastructure build-out. But we have to explicitly remind you, the listener, that our analysis is not financial advice.
Nope.
We are breaking down the data, unpacking the structural market mechanics, and looking at the trends, but you must always do your own independent research and manage your risk before putting your hard-earned capital on the line.
100%.
And if you want a cleaner, more visual way to read trading charts while you do that research, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite featuring visual buy and sell, alerts, trend direction tools, support and resistance zones, and TPSL planning areas.
It's super helpful.
It can really help make charts easier to scan and understand, but please remember it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it certainly does not guarantee results.
Exactly.
Trading involves risk, so always do your own research and manage your risk. Again, this is an affiliate link, meaning we may earn a commission at no extra cost to you.
And if this analysis helped you understand the market a little better, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua Analysis.
I'll leave you with this final provocative thought to ponder as you look at the broader AI landscape. We have spent the last 2 years hyper-focused on the training phase of AI feeding massive data sets into supercomputers to build the models. But as AI moves from the training phase into the inference phase, where billions of everyday users are querying these models on their phones every single second, the massive power demands of these data centers are going to become the ultimate global bottleneck. How will that strict physical power limit dictate which custom silicon companies ultimately win the next decade?